The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, and welcome to the December webinar titled Shifting Gears, courtesy of Principal Financial Group. We appreciate all of you taking the time to join us today. This webinar is part of our ongoing monthly webinar series, and today we will be taking a look at how you can refine your plans to help you feel more prepared for retirement. We will be providing an overview of how to shift gears when you are about 5 years away from retirement. Few housekeeping items before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. During the presentation, feel free to write in any questions you have using the Q&A link on the webinar menu. Then at the end of the presentation, we'll take some time to go through these. With that said, I'd like to introduce our guest speaker, Jose-Luis Montiel, Senior Employee Benefits Specialist at Principal. Jose-Luis is part of the Education Services team at Principal, and in this role helps educate plan participants on issues such as investment option choices, diversification, and retirement planning. I'd like to thank Jose-Luis for joining us today, and with that said, Jose-Luis, I'll turn it over to you.
All right, thanks so much. Again, my name is Jose-Luis, and I represent Principal Financial Group today. Title of our presentation, again, Shifting Gears. This is an exciting and potentially scary time for a lot of people. And as you get closer to retirement, there's so many different details to consider. Whether or not I should stop working, what time, what you're ultimately going to do with that time. Have I saved enough money? How much ultimately is enough? And what about Social Security and other options for possibly creating income? We're going to talk today about refining plans when you're about 5 years out from retirement. And my goal today is ultimately help you shift gears now from that saving to that ultimate distribution of retirement. Now, first question ultimately should be, what's ahead for us? And throughout your working career, you've been heading toward a destination, that destination clearly being retirement, and it's certainly getting a lot closer. The timeline you have on your screen there shows marks you've already hit or getting closer to reach. Certainly 59.5 is a big one for us, and we can start withdrawing money from retirement plans without penalty. 62 being that earliest age to start taking Social Security. 65, 67 being closer to that full retirement age for Social Security. 70 being that latest age we can start taking that Social Security benefit, and 70.5 being that time where we have to start taking required minimum distributions from our 401k plans. So our discussion today is going to help shift gears and navigate through ultimately what we have to come in front of us. So at this point, a few simple steps can potentially have a pretty big impact. And so what we're going to talk about today is shifting the way you think about your own retirement, shifting saving strategies, shifting the way you look at your Social Security benefits, and ultimately shifting from focusing exclusively on saving strategies to begin considering those retirement income strategies available to you as well. So why is it important to start switching gears now? Well, quite simply, we know there may be some bumps in the road ahead, and we want to make sure that we're able to anticipate those and watch out for them before they arise. According to a March 2012 retirement confidence study conducted by the Employee Benefit Research Institute, only about 14% of respondents are very confident that they're going to have enough money to live comfortably throughout their retirement years. Bottom line is that we're going to face risks, and it's important to think about them so we can be better prepared for those risks. As you plan for and settle into retirement, bumps in the road typically can be caused by inflation, longer life expectancy, healthcare costs, market performance, and also the rate of withdrawals from savings in retirement. So we're going to talk a bit today about these risks and possible ways you can try to minimize their impact. So first, let's talk about inflation and life expectancy. Inflation erodes buying power and can cause your annual income to double or more over the course of your retirement. So let's say you need $34,000 a year at retirement to cover your expenses. In 30 years, you may need $71,000 a year to maintain the same standard of living. Increasing savings now is one way to help you ensure that you've saved enough for retirement to account for inflation. Diversified investment mix may also help. According to recent data from the Centers for Disease Control, average life expectancy now is about 78.7 years. Longer lifespans mean longer retirements, which means you could potentially need to save and plan for about 15, 25, or maybe even 30 years in retirement. You might not think that 30 years in retirement applies to you, but what about you and your spouse? The probability of one of a 65-year-old couple living to age 95 is 25%. So what's the impact? If you need $34,000 a year, we multiply that by 30, it comes out to just over $1 million, not including inflation. So think about the number of cars or home maintenance projects you paid for in the last 30 years. Those are the type of things we need to think about when building a retirement budget. So we're also going to need to plan for increasing costs of health care. People are living a lot longer, but it's not by chance. A couple who retired at age 65 in 2012 may need $227,000 to cover health care expenses in retirement, according to just one study we did by the Employee Benefit Research Institute. Keep in mind that the figure I just mentioned doesn't include costs of long-term care or any services like assisted living facilities. At age 65, you'll be eligible for Medicare, which we won't discuss Medicare today, but you'll need to think about it and give a careful review of that as you plan for the next coming years. It's hard to predict market performance, but it's reasonable to assume ups and downs over time. It's generally important that your investment strategy balances stocks, bonds, cash equivalents to give you better potential without exposure to excess risk. You have more time to react to volatile markets while you're still working. You can delay retirement, which allows you to postpone withdrawals from retirement savings, make more contributions, but your options are limited once you're retired. A financial professional can be a huge resource and can help you assess your risk tolerance and help structure your investments to match. Outliving retirement savings is a very real risk as well. To help make savings last, one rule of thumb is to typically withdraw about 4 to 5% or less each year, adjusted annually for inflation. So if I've saved only $100,000 of retirement, 4.5% is going to be $4,500. It's probably not enough for us. We may need to bulk up those savings. It's important to work with a financial professional to establish your plan for generating that retirement income and spending that income in the most reasonable way come that date of our retirement. Now, it's also important that we have a plan for our retirement, right? And certainly as you near your retirement and shift your focus to impact of inflation, life expectancy, and market performance items out of your control, it's also important to spend time thinking about your specific situation. What do you want to do in retirement? What will you need? What income sources will you have available? Have you thought about different strategies for generating income for your savings? Again, our conversation today is going to help you refine your personal plans for retirement and help you thinking in the right mode when getting towards that ultimate plan for your retirement. So let's start about talking about something fun here. Certainly dreams for retirement. A list of things you can do is limitless. If you think about whether or not we want to travel, potentially volunteer, start a business or work part-time, maybe pursue a hobby, go back to school, maybe even considering a move to warmer weather or maybe closer to family. It's important to stay busy and engaged in something, though. This can help us replace those social connections you may have throughout your career. It's a great time to start exploring what you want to do and having opportunities there. Start thinking about how much that might ultimately cost to us as well. If I'm that person that wants to travel, whether that's domestically or internationally, there's certainly going to be different costs with that. You research what you want to do to range from vacationing places. You think you may want to live to search online for volunteer opportunities. Remember, your routine and interactions are going to change. So as you consider financial impact, it's also important for the emotional impact as well. If you think you want to work part-time in retirement for supplemental income or just to stay active, you might want to check with your current employer for part-time opportunities or potentially consulting opportunities, or look for places to work that are related to your personal interests, maybe that hobby you couldn't do before. What you want to do in retirement impacts the income you're going to need, certainly, so your wants are important to consider. Again, it's important that we take a look at what we're ultimately going to be expecting that retirement, so we have a good plan for ourselves moving into that and then ultimately have realistic expectations for ourselves. And let's focus now on what you're going to need to pay for in retirement. Your mortgage, health care, food, upkeep for your residence, car expenses, utilities, potentially credit card or other debt. We want to think broadly for now, but it's important to think about, ultimately what those expenses are going to be for us. So again, we have a better opportunity to expect those expenses when moving into that type of distribution for our retirement. So the big question ultimately is, how can I afford to cover my wants and my needs on my retirement income, considering those road bumps we just covered there? Let's think about some sources of income you may have when you want to retire. Certainly retirement plans, potentially pensions, savings, rental properties, Social Security. How do you bring those sources together, and how much income are you ultimately going to need? Well, one suggestion is that you might need about 85% of your pre-retirement income to maintain your current standard of living while in retirement. You may need more or less depending on your personal situation, and the amount you need each year may increase due to inflation or other factors. So if you earn a salary of about $40,000 a year now, if you need 85%, that's about $34,000 a year in retirement. Again, adjusted over time to account for inflation. We'll talk a little more about generating income in a bit. So as you map your estimated expenses and estimated income, you may find that there's a gap in those savings. Well, the good news is that you still have some time to shift savings into a higher gear. Consolidating various tax-deferred retirement savings accounts, by maybe rolling over account balances into from former employers' plans into your current employer's plan may help you manage and maximize your savings. Having multiple types of savings can be very helpful as well, so including tax-deferred savings in a retirement plan and traditional IRAs, or maybe after-tax dollars in a bank account, Roth IRA, or other investments. It can also help you maximize savings and spread out your tax burden. Qualified contributions to your retirement plan or traditional IRA can reduce current taxable income and potentially grow tax-deferred until withdrawn or retirement. At that point, contributions and any investment gains are taxed as regular income, but you may be in a lower tax bracket subject to a lower rate of taxation. If you save in a Roth IRA, your contributions aren't tax deductible in this year, but qualified withdrawals are generally tax-free. If you're working with a finance professional, they can help you create a savings strategy. They can consider those taxes as well. Certainly saving more is a very important way to look at it as well. If we're able to put more towards our employer's retirement plan, it's a great way to fill a gap. Contributions to your retirement plan are limited to the lesser of the plan or IRS limits. For current calendar year and for next year, that IRS limit is $17,500. For any individual under the age of 50, for any individual over the age of 50, we have that increased catch-up contribution limit available to us. So when it comes to catch-up contributions, you can contribute more on a tax-deferred basis, and that opportunity is available for any individual starting the year in which you turn 50. So what kind of impact could catch-up contributions potentially have on your savings? Well, looking at the chart on the screen here, it assumes a starting salary, or excuse me, a starting balance of $100,000 at age 57, and shows potential difference between annual contributions of $6,000, $17,500, which is that IRS limit, and $23,000, that IRS limit plus that catch-up contribution in those last years before retirement. If we look at the difference there between catch-up contributions, you can see it can be quite a big one for us. And again, it's important that we take advantage of that catch-up opportunity as well with IRA accounts. Individuals 50 or older before the end of 2013 may contribute up to $6,500 to a traditional or if eligible a Roth IRA. You can split contributions between traditional and a Roth IRA, but the combined limit is going to be that $6,500. So next, let's cover Social Security. As you approach retirement, it's important to know what to expect in terms of your Social Security benefits. You can include that within my retirement income plan. You should consult with a finance professional and the Social Security Administration to help ensure that you get the most from your Social Security benefits. Our conversation today, though, will help you position yourself to ask the right questions. So when it comes to Social Security, there's quite a few items to consider there. You'll need to think about the ultimate impact of Social Security will have on your overall income, the timing of your request for those benefits, receiving your benefit while you're still working possibly, taxation of those benefits, and options for married couples. For a worker earning $40,000 a year, Social Security may replace about 40% of pre-retirement earnings. Assuming he or she needs to replace that 85 to 100% of pre-retirement income savings, assuming I need to replace that 85 to 100%, and certainly savings and other sources will be needed to make up the additional portion of that 45 to potentially 60% of pre-retirement income. The amount you receive is based on your age at retirement and top 35 years of earnings history. It's essentially looking at the details to make certain you maximize the amount of which you're eligible. You may be able to increase your Social Security benefit through strategic choices related to timing, working, taxes, spousal benefits, and special provisions. Details are somewhat complex, though. I'm going to talk about some of how Social Security provisions work, but not necessarily if they apply to our specific situation. So it's important to consult a financial professional about your specific situation and maximize Social Security, come that opportunity so we get the best opportunity for retirement income. So let's, again, I'm going to discuss more at a high level right now. When it comes to that time to decide when to retire, Social Security benefits are based on your earnings history. When you're eligible depends on your year of birth, which dictates your full retirement age. For most people today, that full retirement age is going to range from 66 to 67. But keep in mind that, again, ultimately it is going to have to do with my date of birth. So, I want to make sure to contact Social Security, make sure what that appropriate timing is for me. You can elect to take Social Security benefits as early as 62, but monthly benefits are reduced if you elect before that full retirement age. So the earlier elect, again, the bigger that reduction is going to be. But the opposite is also true for us as well. For every year I wait past my full retirement age to elect benefit, I earn delayed retirement credits, meaning my monthly benefit increases by about 8% per year up to about age 70. One note to keep in mind is Social Security is built for an actuarially fair, which means that the electing early and getting smaller checks or electing later and getting bigger checks should work out to the same total amount over your expected lifespan. Focus of our discussion on Social Security is best tailored to your income needs. Again, considering what might be best for my potential situation. Keep in mind also that you can start receiving benefits while working. However, benefits may be reduced in that case. This reduction is in addition to the reduction we discussed for electing prior to my full retirement age. If you elect before your full retirement age, you can work and earn up to $15,120 a year before your earnings affect your benefit. After that amount, Social Security Administration withholds about $1 for every 2 you earn over that limit. Similarly, in the year you reach your full retirement age, earnings limit is $40,080. After that, they're going to withhold $1 for every $3 you earn over that limit. As shown, there's no reduction based on earnings when you're at your full retirement age or older. Did you know that when you retire, up to 85% of your Social Security benefits may be taxable? I think a lot of us underestimate that. And the tax rate is based on your provisional income. To figure your annual provisional income, you add your total taxable income, so from wages, potential pension payments, dividends, interest, and other sources, with your tax-exempt interest income, like from maybe potential municipal bonds you might hold, with 50% of your Social Security benefit. And that amount ends up being my provisional income. The chart here shows the percentage of your Social Security benefit that will be taxed based on that provisional income. If you anticipate a reduced provisional income later in retirement, electing a Social Security benefit later may result in less of your benefit being taxed. Putting a portion of your assets in a tax-deferred investment like an annuity may also help reduce the taxation of your Social Security benefit. You'll want to, again, consult a financial professional and the Social Security Administration for additional detail on what might be the best approach for you there. If you're married, you have additional options available to you to maximize your household Social Security benefits as well. Options also apply if you're divorced after being married for 10 years or more, or you aren't currently married to someone else. For details, again, certainly make sure to contact the Social Security Administration. You and your spouse may be eligible for a personal benefit. Spouses with or without a Social Security earnings history are also eligible for a spousal benefit. So while benefits can be elected as early as age 62, you may not both want to collect at that time. As you consider when to elect, you and your spouse should review the estimated personal benefit amounts at various ages. Then consider whether it makes sense for you to collect the spousal benefit in place of your personal benefit. If you're married, keep in mind you receive the spousal benefit in place of your own benefit, so it's not in addition to. The spousal benefit you receive does not change your spouse's personal benefit. If you wait to elect benefits at or after your full retirement age, you may elect a spousal-only benefit and can later exchange it for your own personal benefit. In order for your claim as a spousal benefit, your spouse must have already claimed their personal benefit. If you claim the spousal benefit at or after your full retirement age, the amount is 50% of your spouse's full retirement benefit, even if your spouse is not yet at their full retirement age. The spousal benefit amount is reduced if you claim it prior to reaching your full retirement age as well. Another benefit for married couples is the survivor's benefit. Upon the death of your spouse, the survivor's benefit entitles you to exchange your personal benefit for your spouse's Social Security if their personal benefit was greater than your own. When determining when to elect Social Security benefits, again, couples may want to consider whether in the advent of death of one spouse, the Social Security benefit for the surviving spouse would be adequate. This may impact whether or not you claim personal benefits later in order to earn those delayed retirement credits. We'll talk briefly today about two strategies you might want to consider. The claim and suspend and claim now, claim more later strategies work in tandem with the spousal benefit and may help you maximize your Social Security benefit. You'll see general definitions and benefits here on the screen. I'll also talk through a few examples. So first there's a claim and suspend. So let's say Jeff and Laura both reach their full retirement age of 66. Jeff, the higher wage earner, decides to continue working. He claims and suspends his benefit, which allows Laura to claim a spousal benefit in place of her personal benefit. While Jeff's personal benefit is suspended, he earns delayed retirement credits. When Jeff claims his personal benefit, Laura can revert to her personal benefit, increased by delayed retirement credits, or she can continue to receive the spousal benefit, whichever is greater. There's also the claim now, claim more later. I'll give you a couple examples of that. First, John and Sarah, who have similar earnings records, both reach their full retirement age of 66. Instead of each claiming their $1,500 personal benefit, John claims his personal benefit and Sarah claims his spousal benefit of $750 for total Social Security income of $2,250 each month. When she exchanges a spousal benefit for her personal benefit at age 70, her benefit will be increased by the delayed retirement credits, increasing their total Social Security income. Or in another scenario, let's say Mary retires early at age 62 and begins receiving monthly Social Security benefit of $870. At age 66, which is her full retirement age, her husband Alex begins receiving a spousal benefit of $610 each month, which is half of Mary's full retirement benefit. He also continues to work as a benefit each month. The couple is able to collect Mary's benefit of $870, the spousal benefit of $610, and Alex's salary. In addition, Alex will earn delayed retirement credits, which will increase his personal benefit. So when he swaps his spousal benefit with his personal benefit at age 70, he will receive $2,375 each month. She will continue to earn that $870, putting them in that better situation. So again, there's a couple scenarios important to keep in mind before requesting those benefits. And it might be appropriate for me to request an estimate. Keep in mind that in addition to consulting with a financial professional, you may want to become more familiar with the Social Security Administration website and the different resources out there. When you're ready, you can get an estimate of Social Security payments at the website you see on the screen there, that www.ssa.gov/estimator. Again, moving into retirement income, perhaps the most important shift when you approach your retirement is that shift from savings to actually taking those distributions or drawing income from your savings. Although it's still important that you continue to save, it's important to start thinking about a retirement income strategy that will last throughout retirement, keep pace with inflation, and account for different health care costs to help you maintain your current standard of living. If you need to bring in, say, that $34,000 each year and you anticipate getting about $16,000 each year from Social Security, how you generate that additional $18,000 that you need. You may have a pension benefit or other guaranteed sources of income. To make up the rest, you'll need to look at savings in your employer's retirement plan and outside savings as well, to different types of investments. Once you determine what income sources you'll have, you'll need to think about how to use them to cover your expenses. It's important to think about options related to your retirement savings. We're going to focus today on your retirement plan savings. Then you'll think about converting those savings into different types of income. And again, taking action to create income. Our discussion today will give you a basis for that conversation with your financial professional. Keep in mind that Pensionmark also has a wealth management division with different, certified financial planners that can help you out thinking about ultimately, what you want to be thinking in terms of your personal situations and building ultimately that retirement income plan. So we started thinking of your expenses in terms of wants and needs, because you do have expenses and the needs that are going to be critical for us as well. The wants will add some flavor to life, but you may suffer without having the needs covered. We can look at your retirement sources the same way and allocate sources of income to the needs first, then address the wants. One way to cover expenses is to use income from fixed or guaranteed sources like Social Security or potentially any company pension benefit, annuity products, and any wages you earn in retirement to cover those needs, things like food, clothing, shelter, health care, transportations, and certainly taxes. And to use withdrawals from savings in a retirement plan, IRA, personal savings, and other investments to cover those wants, things like those hobbies, potential travel, entertainment, club memberships, gifts, and donations. We touched briefly on limiting withdrawals from these sources to 4 to 5% a year, adjusted over time for inflation. At and through retirement, you'll need to consider the impact of income taxes. Again, your financial professional can help you make a plan for when and how to draw from various sources, including accounts built with pre-tax and other pre-tax and after-tax contributions. So again, the next question is what to do with retirement plan savings. When you look at the retirement plan savings, you have several options. You can leave those savings in your employer's retirement plan. You can roll a portion or all of the balance into an IRA, or you could cash out, but that's typically not advised due to the associated tax burden with, cashing out an entire retirement plan benefit. So why might you leave the savings in your employer's retirement plan? A primary reason being simplicity. If you aren't sure what you want to do with your savings in the plan, you don't have to do anything in most cases. You can leave funds where they are until you're ready to purchase products or draw income. Maybe you want to avoid taking your balance from the plan when market performance is low, or just until you're ready to make a decision. Perhaps you maybe already rolled other accounts into the plan, or you want to consolidate funds prior to retirement. Keeping funds in the plan may be right for you if you're happy with your plan's investment options, and you want continued access to the services, tools, and assistance provided by the principal. It's also important to note that if you're separated from service with your employer at or after age 55, you may withdraw funds from the plan between ages 55 and 59.5 without incurring a 10% early withdrawal penalty, like you would in an IRA. When you reach the full retirement age as defined by the plan, you'll have a range of options for withdrawals. You defer the tax burden incurred by taking a lump sum withdrawal. So let's talk why you might want to choose about rolling over funds into an IRA. One of the big ones is maybe because you want control, or I should say more control or more choices. Funds in a rollover IRA can be invested in a wide variety of investment choices. Many financial institutions also give you flexible access to rollover IRA funds by allowing you to set up automatic withdrawal schedules or write checks on the funds. A rollover IRA can also give you a convenient investment vehicle for consolidating various accounts from former employers' retirement plans. If you change jobs throughout your career and have more than one or two different employer-sponsored retirement plan accounts, you may be able to combine all those retirement funds into one rollover IRA, which may be easier for you to manage your savings. With this option, you can take withdrawals starting at age 59.5 with no early withdrawal penalty. An IRA also allows you to defer the tax burden of cashing out. So another option is to cash out, or to take a lump sum distribution from your savings when you retire. Those options typically not advised due to the associated tax burden. For example, say you had $100,000 in retirement plan savings and you want to draw out $5,000 of income from it per year. If you take periodic withdrawals in the plan or rollover IRA, the $5,000 of income is taxable as ordinary income. If you decide instead to take the full $100,000 as lump sum, that entire $100,000 would be taxable as ordinary income in that year, subjecting you to any applicable IRS penalties and taxes, specifically 20% or $20,000 in this case. The distribution is automatically withheld for federal income tax withholding and reported to the IRS. The distribution also may be subject to state and local taxation. Plus, if you take a lump sum distribution prior to reaching age 59.5, another 10% may be subject to the early withdrawal penalty. Again, keep in mind that you can keep funds in the plan until you're ready to make another decision. So if you don't want to stay in the plan or roll over funds over to an IRA, you may want to work with a financial professional to move funds into other savings or investment products. Again, keep in mind that Pensionmark does have a wealth management platform where they can help you with those types of questions. If you're moving into that situation of considering what I might want to do, certainly you can contact Principal at our 1-800 number, that 547-7754 number. Again, there's important considerations to think about. That's going to end my conversation for today. Ultimately, again, keep in mind you can always keep up with Pensionmark by certainly staying connected with them through social media. You have the Facebook, Twitter, YouTube, and LinkedIn sites there for you. Similarly, you can certainly contact Principal. We have the same, social media links available to you as well. Again, the whole idea of this presentation today was shifting mindsets from that accumulation into that distribution phase, thinking about ultimate risks we're going to be facing in retirement and making sure that we've anticipated those risks so we can build an appropriate plan for ourselves moving forward. When it comes to those retirement income strategies, again, Pensionmark's going to be a great resource for you. Certainly you can contact Principal with any questions you have down the line as well. But thank you all so much for your time today. I appreciate that.
Great. Thank you, Jose-Luis. That was all great information. I don't see any questions currently, but if you do have any, go ahead and submit those through the Q&A. And like Jose said, you can always reach out to your dedicated staff here at Pensionmark, and we're more than happy to help with any of your retirement questions. You can reach us at 888-201-5488, or you can always email us at info@pensionmark.com, and we'll be sure to address your questions. So still not seeing any questions come in, so at this point, again, thank you, Jose-Luis, for all the information, and that will conclude the webinar for today.
Thanks so much.